Physical Gold Fund presents the Gold Chronicles with Jim Rickards and Alex Stanczyk. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest podcast with Jim Rickards and Alex Stanczyk in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management, a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. Great to be with you.
We also have with us Alex Stanczyk, the managing director of Physical Gold Fund. Alex is an expert in the physical gold industry, dealing with the logistics chain from refinery to secure transport and vaulting, and he's lectured globally to investor, institutional and government audiences on the role of gold, both in the international monetary system and in investment portfolios. Hello, Alex, and over to you.
Hi, John. Excited to be here and looking forward to today's conversation. Jim, you recently just got back from South by Southwest. Before we jump into this, do you have any interesting insights you'd like to share from this event?
You're right. I just flew in from Austin the other day, and it was my first time at South by Southwest. Of course, it's been going on for a long time and has a great following. Interesting mixture. They've sort of expanded the menu, so now they have a film festival for a few days, then they switch to tech and interactive for a few days, and then they finish up with music, which of course is the root of South by Southwest. That's how it all began. So it's sort of a mixture of techno geeks and spring break partiers and music producers and talent. So it's really, and of course they block off all the streets, so it's a little bit of a street fair, maybe like New Orleans at Mardi Gras. But the highlight for me, I was down there participating in the launch of a new media platform, and a number of the other participants were there. But I actually got to play a few hands of Texas Hold'em with Phil Hellmuth. And for listeners who may not know, Phil is the 14-time world champion of poker. So this is like this is like sparring in the ring with Muhammad Ali back in the day. But Phil could not have been nicer, and we had a lot of fun with that. So certainly enjoyed that. Met a lot of other great folks. But Phil did have some interesting insights. World champion of poker. You figure, obviously a smart guy, but great intuition and a very obviously sharp and incisive mind. And we talked a little bit at lunch before our poker game about efforts to create algorithms that could beat him or anybody in poker, basically poker playing algorithms. And of course, there's a long history of that with IBM and trying to beat Garry Kasparov, champion at the time in chess, and had occasion to talk to Gary about it. And he knew his days were numbered. He was actually, he defeated a couple IBM programs, and finally they came up with one called Blue Gene that was able to beat him. But I had lunch with him before that contest, and he said, I'm going to beat them next time, and they're going to beat me the time after that, because I can sort of reverse engineer what their developers are doing. But of course, chess, there's nothing random in chess. It's a deep game, but it's a kind of mechanical game in the sense that there are a finite number of moves and results. Although finite is, I'll put that in quotation marks because it's quite a large number. But poker is different because you have more of an element of luck. But what Phil said to me is he's been playing some of these algorithms, and he beats them routinely. And the reason is that nothing in artificial intelligence has been able to come close to a poker player's intuition about, fear, spotting a weak hand, understanding when the other guy is bluffing. These are things that no amount of automation has caught up to yet. So I found it an interesting insight. And actually, me, Alex, I carry that over into the gold market and the financial markets. And when I look at all the high frequency trading and automated trading, and I think 90% or more of the trading on the New York Stock Exchange these days is completely automated. But I still I think the ability to, as Phil put it, smell fear in markets, and that the human nature, those herding instincts, crowding in, and then everyone trying to go for the exits at once. Those are things that you can't automate. And I think investors always need to bear in mind. So I think there are some lessons there for gold investors and investors in other assets as well.
Yep, fascinating, and I have to agree with that. That entire element of being able to spot sort of what's going on with the crowd and just sense that. I'm not sure that we'll be able to teach machines how to be able to do that, but definitely an interesting topic there. So let's turn our attention to markets and the recent FOMC meeting. Your track record of projecting U.S. Fed moves is one of the best there is. As far as you're aware, or I should say, as you are aware, the Fed just hiked interest rates. It seems the FOMC is pretty divided, though, in its views. Members of the Fed, such as the Atlanta Fed, they don't really see eye to eye with Yellen's narrative. We know that the Fed does not really have the best record for forecasting the economy. Talk to me a little bit about why does this matter, and what do you think the Fed's going to end up doing moving forward for the rest of the year here?
It's a great question, Alex. And, I have been able to call Fed moves with a lot of accuracy going all the way back to September 2013. That was not long after the famous taper talk by Ben Bernanke. That was May 2013. And at the time, Bernanke did not say he was going to, he said we're nowhere near raising interest rates, but he said we might begin to reduce our asset purchases. In other words, reduce money printing. Although he didn't do it in May, he just said we're thinking about it. Well, by September, the entire market was poised for that move. And I said it wouldn't happen. It didn't. It finally did, a few months later. Same thing in September 2015. The market was poised for what they call liftoff, which was the first interest rate hike. That was long after they had finished the taper, so there was no more money printing. They were still printing money to roll over maturing assets, but they weren't expanding the balance sheet. That ended in late 2014. It took all the way until September 2015, and there was a lot of expectation about liftoff. And I said they're not going to lift off, and they didn't. That happened again 3 months later. In December 2015 was the first rate hike. And then in late 2014, I was saying they will not be able to hike rates in all of 2015. Well, that was, and the markets were predicting March, June, September, December for rate hikes, and it was through 8 meetings. No, they didn't hike rates. Finally, December 2015, it was clear that they would. So, and then this most recent hike, I called for it in December 2016, so a little over about 3 months ago, and the market expectation used Fed funds futures contracts as implying a probability of a rate hike, and that's the wisdom of crowds. That's the considered judgment of all market participants. They had a 28% December and 30% through January through February. It wasn't until, and I was 75, 80% and basically leaning clearly to a rate hike. That's what I was forecasting. And suddenly, in 3 trading days, from February 28th to March 2nd, it skyrocketed. The odds, the probability skyrocketed to 50%, then 80%, then 90%. Of course, by Fed Day, March 15th, everybody was at 100%. That was easy. But there were 2 months there when the market was 30%, and I was 75, 80, and then we all converged at 100. So here's what I would say about that, Alex. I don't have a crystal ball. It's not like I'm doing some mumbo jumbo to figure this out, and I'm absolutely not smarter than my peers or the other people doing this. I know a lot of the quants and PhDs and a lot of friends on Wall Street, and they're all pretty smart. All I have is a better model, and it's actually an unbelievably simple model. I mean, it's not like you need IBM's Watson to do your processing for you. But I've said all along, and you and I have discussed this many times, if you have the wrong model, you're going to get the wrong forecast every time. If you have the right model, you have a much better chance of getting the forecast right. So it's really just about the model. And I'm always happy to explain it to the listeners, because the thing is, the model works, and it still works. It is your best guide to what's going to happen with the Fed going forward. And of course, that has implications for the price of gold, because there's some extent, not perfect by any means, but some extent to which the price of gold is correlated to the value of the dollar, and that in turn ties to interest rates. So if you can get the Fed forecast right, you can at least have some insights into what's going to happen with the price of gold.
Yep, very much so. Okay, so let's talk a little bit about Trump's fiscal plan and how this is going to work in terms of tax cuts he wants to make, et cetera. Keeping in mind his fiscal plan as it's already been outlined, as well as we've sort of recently been reminded that the U.S. government is now dealing once again with the so-called debt ceiling. This is a sort of an issue that keeps coming up, obviously, and doesn't seem to be going away. You've recently suggested that perhaps VAT may be a way for Trump to cut taxes and get the fiscal program that he wants. So VAT is an acronym for value-added tax. It's pretty common in Europe. Can you briefly explain what VAT is, and do you consider Trump's plan doable if VAT is made into law?
Well, I'd be happy to do that, Alex, and also talk about the impact of it. But I think to properly address that question, it's got to be put in the broader context of the global economy, or not, if not the global economy, at least the U.S. economy. But of course, that's a big part of the global economy. So, VAT, as you said, stands for value-added tax. It's very common around the world, by the way. The United States is the only major economy that does not have a value-added tax. The Treasury has wanted one forever, and this goes through Republican administrations, Democratic administrations for decades. My background before I started doing more economic work and writing, I spent the first 10 years of my career as International Tax Counsel. I was for Citibank, one of the world's largest financial institutions, of course, and I was really had a background as a tax lawyer, so I'm pretty familiar with the ins and outs of this. So you can think of value-added tax as kind of a sales tax. There's a little more to it than that, because there's a value chain where you start with raw materials and inputs, and then they sell to a manufacturer, and then they sell to a distributor, and then they sell to wholesale, they sell to retail, and then retail sells to you and me. So there's a whole chain, and you actually apply the VAT at every step in the chain, only on the portion of value that you added. That's why they call it a value-added tax. So there's a wholesale element to it, but it's basically a sales tax. Every time you sell your goods, whether you're in the intermediate stage of the value chain or the end stage, you charge the value-added tax for the increase in the value relative to what you paid. So that's your value add you pay tax on. So it's kind of like a super sales tax. The reason the Treasury loves it, it generates a ton of revenue. It's also easy to sneak up on people. What you do is you start at 3%, or I don't know where they'll start. I'll make up a number. Start at 3% or 4%. Next thing you know, it's 5%, then it's 7%, then it's 8%. Kind of like state sales taxes. I think a lot of listeners have experience with state sales taxes that seem to only go one way, up, and never go down. But be that as it may, it's a great revenue and a great way to kind of pick people's pockets. It's a great revenue raiser in a way to pick people's pockets. But the reason it's important is that it plugs into Trump's bigger picture fiscal plan. Now, what's his fiscal plan? And of course, this gets back to the stock market and ultimately to the gold market. So his fiscal plan is cut taxes and $1 trillion of infrastructure spending. He also, the third leg of the stool is regulatory reform. Let's leave that to one side for the moment, although that is, I think, a positive for the economy. But basically, he wants to cut taxes and spend more money, which implies bigger deficits. But the Congress is saying, well, hold on. We'll consider the tax cuts, but they have to be what they call revenue neutral, which just means that if you're going to cut them in one place, you have to raise them someplace else. And so what kind of tax cuts does Trump want? Well, they're huge. He, as Trump would say, huge or amazing. And he wants to cut the individual tax rate from roughly 39% to 33%. He wants to cut the corporate tax rate from 35% to maybe 25%. He wants to bring back offshore earnings at maybe some favorable rate, 15%, let's say. all of which will cost the Treasury money relative to what they think they would get in a static projection. So the question Congress is asking is, okay, you're cutting those taxes. Where are you going to raise taxes to make up the difference so we don't have larger deficits? So think about that for a second. If it's revenue neutral and doesn't increase the deficit, where's the stimulus, right? Because the whole idea, like, I like John Maynard Keynes as an economist, but I'm not a Keynesian in terms of deficits as far as the eye can see. But if you believe in Keynesian stimulus, you'd say, well, okay, when the economy's weak as it is now, deficit spending might be a good thing. But if your tax cut is revenue neutral, then there's no additional deficit spending. So it's hard to see where the boost is coming from. But it's actually a little bit worse than that, because you have this concept of the marginal propensity to consume, which varies depending on total income and wealth. And the issue is, well, if you get an extra dollar in your pocket, what are you going to do with it? Are you going to spend the whole dollar? Are you going to spend nothing and stick it in the bank? Are you going to spend 50% or 50 cents? So, well, when you cut taxes, when you cut income taxes from 39% to 33%, that benefit mostly goes to people making, $250,000 per year or more, all the way up to people making $1 billion. They're the ones who are in that tax bracket. When you throw on a value-added tax, or even there's something else called the border adjustment tax, which is the other one that's in the running, that's highly regressive, meaning you're taxing people who can barely get by. But if you have to go to the store and buy food for your family, or you have to go buy clothing at Costco, or you have to do any kind of shopping at all, and you're paying the value-added tax, then you're paying that tax, even though you might be poor or just kind of marginally getting by. So whereas let's say you are making $1 million a year, that's a pretty rare category. But for people in that category, if they get a tax cut, are they really going to spend much more? Probably not. The people making that kind of money, they probably have 3 cars, 5 TV sets, and 2 houses, and they take nice vacations already. Are you going to buy another house or take another vacation? Well, maybe, but probably not. You're probably going to invest the money or save it. So the point is, if you cut taxes on people with a low marginal propensity to consume, meaning they're not going to spend a lot more, and you raise taxes on people who with a high marginal propensity to consume, meaning it really comes out of their pockets and maybe they spend less, that's a headwind for the economy. That actually hurts what's called aggregate demand. It hurts the economy. So now you've got 2 things going on. One is you're revenue neutral. So there's no Keynesian multiplier, Keynesian stimulus. Probably wouldn't be much of one anyway, but now you're going to get none if you're revenue neutral. Plus, it's not neutral in terms of consumption. You're actually hurting consumption. Now, some of these things, there are advocates for them long term, but short term, this is going to basically cause the economy to slam on the brakes. I don't understand why the stock market is so euphoric over Trump's plans, because when you look at them, it's hard to see where the stimulus is coming from. The stock market does look like a bubble to me. That doesn't mean it can't go on. I mean, one of the lessons of bubbles is that they go on a lot longer than you think. So I'm not predicting that the bubble is going to burst tomorrow, and I'm not saying people should run out and short stocks. What I'm saying is we're well into bubble territory. And just as a very simple example, right after the election in early November, the stock market, I'll use Dow Jones, it went up 1,000 points based on the Trump fiscal plan and his tax cuts. Then in December, they came out with some more detail about the timing, and it went up another 1,000 points on the tax cuts. And then in January, around the time of the President's State of the Union address, I think that might have actually been in February, they had more details, and Secretary Mnuchin was adamant about getting it done by August. The stock market went up another 1,000%, 1,000 points. And I'm looking at that, I'm saying, hey, you just rallied 3 times on the same news. I mean, there aren't going to be 3 tax cuts. There's only going to be 1 tax cut, but the market rallied 3 times on the same news. That's bubbly behavior, and that looks like the market's way ahead of itself. And when some of this reality, and there's a lot more to say, but I'll wrap it up here. But when some of this reality, meaning the stimulus is not going to be as great as expected, the impact of the tax cuts is not going to be as great as expected, the whole thing's going to take longer than expected, this is going to be a bit of a wake-up call for the stock market, and could combine with some other things, give us a correction, a serious correction, maybe down 10% or so by the summer.
A follow-up question to the VAT topic. Is there a scenario where VAT could be perceived by consumers sort of as, instead of them looking at it and going, okay, this is additional tax, but just looking at it and going, prices of things are going up? Could this be some sort of psychological trigger that could accelerate the velocity of money? Could this be an inflationary inducing kind of an effect?
It could be. That's a very good question. In fact, prices will go up. You'll have to, I'll leave it to the people at the Commerce Department to sort out how they want to define inflation. But, if you have something that's $100 and you slap on a 5% VAT, all of a sudden it's $105. Now, I'm sure the talking heads and people on financial television will tell you, oh, don't worry about it. It's not inflation. It's only a tax. Well, I'm not sure the average consumer thinks of it that way. For them, if you're paying $105, that's 5% inflation overnight. There are other weird effects we've seen in Japan, which is if they announce an effective date, you might actually get a short-term boost in consumption, which would be short-term good for the economy, because everyone will run out and buy stuff before the effective date. If they said, we're going to, this is in the bill, it's going to pass the Congress, the effective date is September 1st, you might see everyone run around the end of August shopping like crazy to beat the sales tax, to beat the value-added tax. And that did happen in Japan, but of course, it's only a Kool-Aid high. It's a short-term boost because the day the tax comes into effect, the economy falls off a cliff because all you did was bring all that aggregate demand forward to get ahead of the deadline. So it's still early days. This bill has to wind its way through Congress, and I know the value-added tax is getting a lot of consideration. It always has. When I spoke to top people at the tax section of the American Bar Association, these are people who, they're career professionals, they're lawyers, but they talk to the Treasury on a regular basis about policy. And one of those top people told me a couple of years ago, she said, the Treasury this is like during the Obama administration, said the Treasury has given up on reforming the Internal Revenue Code. It's just too much of a mess. The only way they see that we can keep the U.S. from going broke and raise revenue is with a value-added tax, with a VAT. So that's the default position. Well, now with the Trump administration, Congress saying you got to be revenue neutral, and Trump committed to income tax cuts, there's no way to square that circle without a big revenue raiser, and that's the biggest thing out there. So we sort of have to keep an eye on it, but it may be coming. But it can have these weird effects of bumping inflation that could, you've got offsetting forces, and that's what makes it tricky. On the one hand, the sticker shock at the counter might give you an inflationary mindset. On the other hand, if everyone's running around spending before the tax and then stop spending after the tax, that could actually be deflationary if aggregate demand drops and the economy runs into a brick wall. So the problem with all this, Alex, is it's not difficult to define theoretical outcomes based on what we know, but because these things are behavioral and psychological, really what I call emergent properties of complex dynamic systems, basically we're manipulating behavior, and we shouldn't be surprised if we get some very bad results.
Yeah, exactly. Okay. So I had a really interesting conversation with a friend of mine named Ronnie Stoffel, who manages a fund out of Liechtenstein called Incrementum. You also know Ronnie. Our conversation was around this idea of fragility in markets, and it seems clear to me and to other observers like Ronnie and some other people who I consider to be very smart, that the markets are becoming increasingly fragile. So if we can pick up on a comment that you made in a recent interview, you said that companies that are the most vulnerable to financial turmoil are those that rely heavily on high leverage and financial engineering to produce returns. So you included also banks in that category, and you forecast some potentially dire outcomes and consequences to this. So for those of our listeners who are new to these concepts, can you touch on why these are legitimate concerns and more likely to play out than not?
Absolutely. And you're right. I do know Ronnie very well. He's a great guy and a very astute market analyst. He's I call him an Austrian for the 21st century, meaning he's a follower of Austrian economics, but he's followed a lot of recent developments in economics and theoretical approaches to it. So he brings that Austrian mindset with a lot of really good up-to-date technology, and I think he is one of the sharpest commentators and fund managers out there. Is a great guy. So let's address that issue of fragility and the impact of leverage. Now, I'll start with leverage. Leverage is a pretty simple thing to understand. Well, what it means is borrowed money. Now, borrowed money, or it could be derivatives, it could be off-balance sheet contracts, it could be futures and options which have embedded leverage, but or it could be outright borrowed money. But what all it means is that you get more of whatever you're betting on. So if I buy a stock for cash and it goes up 10%, well, I made 10%, at least on a mark-to-market basis. But if I buy stock on margin, borrow half the money, and it goes up 10%, I don't owe any more debt. I owe the original debt, so I actually made 20% because I only had 50% equity. So my 10% return becomes a 20% return if I bought it with half borrowed money, because I'm making the same amount of profit on half the investment. And so obviously that gets a higher return. Of course, it works in reverse. You can lose twice as much money, or if you're leveraged 10 to 1, you can lose 10 times as much money. So what leverage does in any form, whether it's outright debt, a note, or a derivative contract of some kind, it just amplifies your return. Depending on the amount of leverage, you'll make twice as much, or 10 times as much, or 100 times as much, and also you can lose just as much. But if you're on the losing side of a highly leveraged trade, a very bad thing happens, which is you go bankrupt. In other words, if I've got $1 million and I leverage it 10 to 1, let's say, so I've got a $10 million bet with $1 million of borrowed equity, with $1 million of equity and $9 million of borrowed money. Well, now if my $10 million bet goes down 10%, I've lost 100% of my equity because I'm leveraged 10 to 1 in that example. So it only takes relatively small market moves to completely wipe out your equity and force a bankruptcy. And of course, this is what was happening in 2008. This is what happened in 1998. It happens to individual firms along the way. You see it over and over. So people make these leverage bets. So now you get into something. So that's the impact of leverage. But now you get into something called contagion, which is or IMF likes to call it spillovers, but it's the same thing. Where so I made a big leverage bet. And if you win, it's nice because you make a lot more money, right? Everyone likes that. But if you lose, you don't just lose more money. That's bad, but you actually wipe out your equity and go bankrupt. So you walk away from the table. But presumably you have trading partners. The thing about trading in capital markets, commodities markets, stocks, bonds, et cetera, is that, as Paul Simon once said in the song, one man's ceiling is another man's floor. Well, one firm's mark-to-market loss is somebody else's mark-to-market gain. And if the loser goes bankrupt, then the person on the other side of the trade who had the gain goes to collect his winnings, and the guy's not there. So it's like you won at the casino, and you take your chips over, and somehow between the table and the cashier, the casino shuts down and goes bankrupt. You're sitting there with a bunch of plastic chips, basically, or rubber chips, and you can't get your money. So now the guy who did the winning trade, the guy who was on the right side of the trade, he might find that he's in financial distress, not because he made a bad trade, but because he had a bad credit. He did the trade with a person who's no longer there. And of course, this is exactly what happened with AIG in 2008. AIG had all the losing bets. Goldman and others, Citibank and many others had the winning bets. But when they turned to AIG to collect, AIG was practically bankrupt, couldn't pay. So the government had to bail out AIG, not because they loved AIG, but because they said, if we don't bail out AIG, all these other firms, starting with Goldman, are going to go bankrupt. So that's how the danger spills over, or there's contagion. Think of it just like a disease, from where one person affects another and affects another. And that just gets worse. All of a sudden, you go from, individual hedge funds and small institutions and individuals to some dealers go bankrupt, and then they have a clearing broker, and that guy goes bankrupt. And then next thing you know, you're threatening the solvency of the entire, futures exchange or derivatives exchange or the banking system as a whole. So that's how it spins out of control, and that's where the fragility comes in. Now, that's kind of well understood, meaning people have observed that many times, and they, credit officers try to prevent it by not permitting that much leverage, but they never get it right. There's so much of it's hidden, so much of it's off balance sheet, so much of it migrates to new ways. The regulators, they're always fighting the last fire. After 2008, they were very, very determined to make sure that we didn't have another housing crisis, housing credit crisis. Well, I don't think we're going to have another housing credit crisis. It's extremely difficult to get a housing loan right now. But how about dollar-denominated emerging markets debt? How about the high-yield market? How about various forms of derivatives? How about buyout loans? Loans that corporations take out to buy back their own stock or pay dividends. Or takeover loans. There are a whole host of other areas where this problem could emerge. And just because regulators ran around and cleaned up the mortgage market doesn't mean that they have a good handle on all those other things. I mean, then you burrow down inside the off-balance sheet commitments of a major bank. You get into things like asset swaps. What's an asset swap? Well, so I want to borrow money, but the person I'm dealing with only takes high-quality collateral, let's say Treasury notes. And I've got a bunch of, garbagey kind of corporate bonds on my books. So I go to like a mutual fund or a pension fund, and I say, hey, I'll swap you my corporate bonds for your Treasury notes on an agreement to swap back, so it could be a 1 week or 1 month or overnight trade or whatever, but I give you a whole bunch of corporate stuff as collateral and you give me Treasuries. Then I turn around and pledge the Treasuries to the first guy who didn't want my corporate junk, but he will take the Treasuries. So I'm sitting there swapping corporates for Treasuries so that I can do another deal where I post Treasuries as collateral and get some other line of credit so I can add some more leverage on top of that. Well, think about it for a second with this asset swap, which, by the way, is an off-balance sheet transaction. It's invisible unless you know where to look and you go in and look for it. Well, what started out as a two-party trade between the bank and the counterparty turned into a three-party trade between the counterparty, the bank, and the pension fund, in my example. And instead of, two assets being swapped, you got three or four, and this goes on all the time. So all these conversion features, asset swap features, off-balance sheet, they're expanding. And this is where we now segue into complexity theory and how I really think about markets, which is that, and to Ronnie's point that markets are getting more fragile, I think that's right, but I would say they're always fragile to some extent. But the question is, how do we think about the risk? How do we measure it? And the way I think about it is in terms of systemic scale. And the scale is just a fancy word, more technical word for the size of the system. But here's the point. The risk of the system, I'll define risk as the worst thing that can happen. So what's the biggest meltdown, the biggest collapse, the most contagion, the 2008 type of event? What's the biggest disaster that can happen in a system? Well, intuition says, well, if I double the size of the system, I probably double the risk, or if I triple the size of the system, I probably triple the risk. Although the value at risk jockeys, risk managers on Wall Street wouldn't even say that. They'd say, well, no, you can double or triple the system and increase the risk not at all or very little, because it's long, short, long, short, long, short. In other words, you're pairing off all these trades and they net out to a small number, and it's only that small number that really reflects the risk, which is complete nonsense, by the way, because for the reason I mentioned earlier, which is that works when you don't need it. I mean, that way of thinking about risk is fine when nothing bad is happening. But the minute something bad happens, you don't get to pair off because they're two different counterparties, and now you're worried about the counterparty of your winning trade. Like, you're stuck with the losing trade, but the winning trade that supposedly pairs off from a market risk perspective, all of a sudden that guy's going bankrupt. So the market risk converts into credit risk, and you still lose, and you still go bankrupt yourself. So that's what value at risk is, no capacity to deal with that at all. But leaving that aside, so the value at risk, people would say risk goes up very little. people using, kind of intuition would say you double the system, you double the risk. The fact is, if you double the system, you don't double the risk. You increase it exponentially. You increase it by perhaps a factor of 10, even more. And so as we've seen these off-balance sheet relationships, derivatives, outright leverage, hidden assets, as we've seen all this grow, think to yourself, well, the system is not getting more risky. It's getting exponentially more risky. So we're at a point now where the biggest banks are bigger than they were in 2008. They have a higher percentage of the total banking assets. The off-balance sheet exposures are larger. The amount of debt in the world is significantly larger. The notion that we've deleveraged the system since 2008 is nonsense. We've not only increased the leverage, meaning the debt and the derivatives, but we've concentrated it in fewer and fewer hands, which makes it even more dangerous, more likely that one party in distress is going to take down the entire system. So what I expect, based on very good science, not just my gut, but you can actually see it, unfortunately, in front of your eyes, is a new collapse coming, far worse than what happened in 2008. And I think that's Ronnie's point, and I agree completely.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.